day, everyone. Thank you for joining me. I'm Tamara Kukshinovich, and I'm going to take you through Supergroup's interim results. Pricing pressures and increased competition have affected the logistic industry globally. In South Africa, the industry is closely linked to the current state of the economy. Pressure is placed on operating margins due to the high level of competition. This emphasizes the need for strict cost controls and the upkeep of a strong balance sheet. Given the poor economic conditions, volumes are expected to remain under pressure in the short term. Earnings are supported by the recent contract wins in the consumer-facing operations, the strong South African commodities environment, and the improved operational efficiencies. However, the release of government tenders are scarce leading up to the national election. Supergroup holds 57.5% in SG Fleet, which is listed on the Australian Stock Exchange. The market value of the stake is 974 cents per Supergroup share and is trading at a historical PE multiple of 9 times. In Australia, the consumer environment is expected to remain a headwind, but the balance sheet risk is estimated to be low. In Europe, the supply chain businesses are facing many uncertainties, which is impacting the outlook. We feel these concerns are fairly reflected in the current valuation. As you can see on the graph, the counter is trading at a discount to its historical averages. It is also trading at the lower end of peer multiples. Trading at 1.2 times its net asset value and a forward PE multiple of 10 times, we feel the share offers value and would recommend an overweight exposure. Revenue increased by 8.2% to 19.4 billion rand, which was mainly due to the higher volumes in the supply chain Africa commodities businesses, the logistics business, and the higher SG Fleet contribution due to the adoption of IFRS 15. However, the change in the Mercedes-Benz model slightly offset the revenue. Operating profit before capital items increased by 11.1% to 1.3 billion rand, which was aided by lower amortization costs. Earnings before interest and tax increased by 13% to 1.3 billion rand due to the capital items income of 14.2 million rand, which was received from the sale of the Supply Chain Africa trucks. As a result of an increase in the average interest rate on borrowings, net finance costs increased by 6.3%. Headline earnings increased by 14.1% to 629 million rand. Diluted headline earnings per share increased by 12.3% to 173.5 cents. Diluted earnings per share increased by 15.4% to 175.9 cents due to capital items after tax, which included the profit from the sale of property, plant, and equipment. No dividend was declared for the period in review. Operating cash flow increased by 5.9% to 1.79 billion rand. The group reported a working capital outflow of 293.2 million rand. Capital expenditure of 1.2 billion rand decreased free cash flow. This was mainly due to the high level of purchases of trucks and trailers in the commodity segment. A debt movement of 473.5 million rand was reported. The net asset value increased by 16% to 2,890.93 cents per share. The total assets increased by 4%, mainly due to the purchase of trucks and trailers in the commodities businesses. The return on net operating assets increased to 12.3% and the weighted average cost of capital increased to 9.5%. Net debt increased to 3.1 billion rand, which resulted in a net debt to equity ratio of 29.2%, which is below the internally imposed target of 40%. Interest-bearing borrowings increased by 10.2% as a result of the new corporate bond tranche of 450 million rand. In conclusion, we would recommend an overweight exposure relative to the capped SWIX, which has a weighting of 0.24% in Supergroup. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. A comprehensive company analysis report on Supergroup can be found on the PSG online trading platform. Before we end off, please take note of the following disclaimer. Thank you.